What is a false positive? Have you ever had a transaction blocked or an account frozen when you were just trying to make a purchase? This can happen due to a false positive. So, what exactly is a false positive in the context of security software and fraud prevention? A false positive occurs when a security system mistakenly identifies a legitimate action as suspicious or fraudulent. In online banking, this means that when you log in, make a payment, or transfer money, the system might flag your activity as potentially harmful, even though you are doing nothing wrong. This error happens because these systems use rules and algorithms to look for unusual patterns that might indicate fraud. If the system is too sensitive or not properly tuned, it can misinterpret normal behavior as risky. Banks and credit unions relying heavily on fraud detection software to protect customer accounts. These tools often have preset rules. For example, they might flag transactions over a certain amount or logins from new locations. If you travel and use your card abroad or make a large purchase that is completely legitimate, the system might block that transaction. This creates a false positive, causing inconvenience for you, the customer. The impact of false positives can be significant for both banks and customers. For financial institutions, a high rate of false positives can overwhelm staff who need to investigate each alert. This can delay responses to actual threats. For customers, it can mean blocked transactions, locked accounts, or additional verification steps. This can lead to frustration and a loss of trust in the bank's services. To minimize false positives, banks are constantly updating their detection rules and using more advanced analytics. Some institutions even allow customers to notify them of travel plans or large purchases in advance to reduce unnecessary alerts. It's also important to understand the difference between false positives and false negatives. A false negative is when the system fails to detect actual fraud, allowing criminals to go unnoticed. Banks must find a balance between reducing false positives and avoiding false negatives. Managing false positives is a key focus for financial institutions. Too many false positives waste resources and annoy customers, while too few can let real fraud slip through. Effective fraud prevention requires ongoing adjustments to security measures and sometimes investing in more sophisticated technology. In everyday banking, you might encounter false positives as temporary blocks or requests for additional verification. Banks communicate that these steps, while sometimes inconvenient, are part of their commitment to protecting your funds. Transparency about these actions can help maintain trust even when false positives occur. In summary, a false positive in online banking security is when a legitimate customer action is wrongly identified as fraudulent. Banks and credit unions work hard to reduce these errors to protect customer assets and ensure a positive experience.